Workplace retirement plans have been seen as a big, juicy tax apple for a while. Are your deductions at risk? It would certainly seem that way, as many started to dig into Joe Biden's plan for the older American in a seemingly unassuming paragraph that calls for the equalization of tax deductions into workplace plans. That's very light on details, but one of Biden's economic advisors did expand on the idea. During the Democratic National Convention, he was comparing somebody in a very high tax bracket to somebody in a very low tax bracket, and was doing the math where if they both save $1,000, the one in the 37% tax bracket would get a 37-cent benefit. Whereas the worker who was paying no taxes or in a 0% tax bracket would get no tax deduction. I am going to completely gloss over the fact that we're talking about the fairness of deductibility by comparing somebody who is paying a significant portion of their income in taxes to someone who is apparently paying no taxes, and jump right to the heart of the fact that Mr. Harris's comparison was not entirely accurate. He totally ignored the Savers tax credit, which gives low-income Americans up to a 50% credit for what they contribute to their retirement account. Now, that credit is limited based on income, and a good conservative estimate is maybe only 10% of us are eligible for that credit. So what about the rest of us? What's the plan? Well, we don't know because they don't expand on it. But many are looking back to previous proposals where we would just do away with the deduction based on our income and our rates today and just institute a flat deduction. So I've seen 25, 26% bandied about. No matter your income, if you save $1,000, you get a $250 tax credit for that contribution. Even though we kind of want to get all up in arms because we're losing deductions, I kind of want you guys to break this down with me. Remember, we are in marginal tax brackets. The average effective tax rate in 2018 was 17.8%, okay? So if we were to actually get a 25% credit, that could actually be better for a lot of us if the effective rate stays the same. It could be even better if it's a refundable credit. But this is why it's hard to analyze these, because we can't just look at this policy change in a vacuum. I'm comparing that potential credit to the effective tax rates today. And to that point, I would like to remind everybody that the savings in these plans is tax deferred. We can talk about the equalization of the deduction all you want to, but it's only fair game that on the back end, when the high income earners go to actually distribute and pay taxes on the income for their retirement accounts, that they get an equalization there too. Should we be calling for a flat tax on retirement income? That's it for this week. Hopefully I gave you some good things to think about. It's Jeannie Fisher, the 401k lady.